guys, this video is all about stock dividends and how they work. So this stock video is meant for novices, more beginners who are just trying to learn about what a dividend is and how the whole process works. If you're new to the channel, please hit that subscribe button, give me a thumbs up. So though this YouTube channel has a lot of different content, I do have a lot of stock videos. So if you're interested in more of the stock videos, I'm going to put the playlist in the description below. So stock dividends can be very confusing, especially if you're new to trading. So this video is going to explain two types of stock dividends. Number one is a stock dividend. The second is going to be a cash dividend. So what exactly is a stock dividend? So a stock dividend is a payment to shareholders as an incentive or reward for owning that particular stock. Typically, companies that offer dividends are doing financially well and they're stable, they're consistent. You're not going to find companies that are very volatile giving out dividends. It just won't work. So the reason that stable and financially healthy companies are the ones that offer dividends is because a lot of times they have to actually use their free cash flow to pay for these dividends. So you're not going to find companies that are in debt or that have very few assets. They're not going to be offering dividends. All right, so now we're going to go over the first type of dividend, a stock dividend. A stock dividend, also known as a scrip dividend, is actually where the company is going to offer you additional shares instead of cash. All right, so here's an example of a stock dividend. Stock Z has just announced they're going to give a 5% dividend yield in stocks. So let's say you actually have 100 shares of stock Z. You're going to get 5 shares. So you take 0.05 and you multiply it by the amount of shares that you have. And that's how many additional shares you're going to get. So you're going to get 5 shares from that stock dividend. So in total, you're going to have 105 shares from stock Z. Some of the pros to a stock dividend. Companies offer stock dividends in lieu of cash. They don't have to dip into their assets or free cash balance. It can simply reward you with additional shares. Another positive of a stock dividend is you're actually not taxed until you sell. So even though you get additional shares, you can hold on to those shares without having to pay taxes on them. Now, the negatives of stock dividends is that it dilutes each individual share's value. So though you're getting extra shares, your shares are worth just a little less because the company doesn't actually increase in value because it offered a dividend. So an example of dilution from a stock dividend. Let's say company Z has 1 million shares outstanding. That means 1 million shares out there. Right now, stock Z is trading at $10 per share. That's a $10 million company value right there with the stocks. If they offered that 5% dividend that I gave you the example before, 5% of 1 million is 50,000 shares. So that means they're going to add an additional 50,000 shares. But the $10 million value doesn't go away. It doesn't change. So now company Z has 1,050,000 shares outstanding. So how is this going to affect the stock price? If company Z was trading at $10 per share right before the ex-dividend date, which I'll explain later, on the ex-dividend date, it's actually going to be trading at $9.52 to account for those extra 50 shares. By taking the overall company value of stock Z, which was $10 million, and divide it by 1,050,000, and that will give you now a new share price of $9.52. So on the ex-dividend date, stock Z is actually going to open up at $9.52, even though the day before it opened up at $10 a share. This is to account for the additional shares out there. So that's an example of how stock dividend or releasing new shares can dilute stock price. Each company might have different rules on how long you have to hold certain stocks to receive dividends. All right, so next I'm going to go over the more popular form of dividend, which is a cash dividend. So cash dividends are actually offered by big companies that are making a lot of money. They have enough money to actually reward their investors. So these are companies like IBM, Coca-Cola, Exxon, companies that have a lot of cash. Now, due to the whole coronavirus COVID situation, a lot of companies have temporarily suspended or flat out got rid of dividends. One thing about dividends, they are not guaranteed. Typically, dividends are released with news, and they're going to give you a couple key important dates. The first date you really want to know about is the ex-dividend date, the record date, and the payment date. That news is also going to give you the exact percentage yield of a particular price that certain specialists worked off of. So a cash dividend, similar to a stock dividend, is an incentive or motivation for people to invest in a particular stock. The difference between cash and stock is cash dividends are paid literally in cash. Market specialists take a certain price of the company and they announce a certain percentage dividend yield that they're going to give per share that somebody owns. Usually cash dividends are paid either monthly, quarterly, or semi-annually. So an example of a cash dividend. So stock X is trading at $100 right before its ex-dividend date. Stock X has announced that it's going to give a 3% dividend yield annually. So that means if it's paid biannually, so 2 times, that it's going to be $1.50 each time. It's going to be $3 for the whole year if you kept the whole year, but for each time it pays dividends, which is 2 times, it's going to be $1.50 each time. So what you do is you calculate how much you get in dividends by taking $1.50 and multiplying it by how many shares you own heading into the ex-dividend date. So if you own 10 shares of stock X, you're only going to get $15 worth of dividends, 10 times $1.50. So that's something to be careful too. When you look at dividend yields, you also want to find out if it's an annual dividend yield and how often it pays out. You want to mathematically calculate what you could potentially earn or potentially lose if the stock drops to see if it's worth your while. Dividend reinvestment is also very popular among stock traders, especially retirees, people who are retired and just looking to sit on a little extra income through dividends. So basically people take these dividend releases that they get and they reinvest it into more shares and they kind of just sit and keep collecting the dividends. You obviously have to have a lot of money into accounts. That's why a lot of people use retirements or money they've been saving to do that. In fact, since 1930, 40% of stock returns are based on dividend reinvestments. Okay, now, how exactly do these dates work with getting a dividend? How do you know if you're eligible? There's a couple different terms you want to know. There's the must-own date, which is really the only date that really matters. But in order to know what the must-own date is, you need to know the next concept, which is the ex-dividend date. So the most important dates to look at are the ex-dividend date, and then the day before that is the must-own date. So in order to be eligible for a dividend, you must be a shareholder by the end of close right before the ex-dividend date. The last trading day, business day that's open, you have to be a shareholder before that ex-dividend date. So for example, if I want to be a shareholder and receive a dividend of stock X, and they have an ex-dividend date, January 5th, I need to be a stock owner of that company through close on January 4th, if those 2 days were open for market trading. So you always have to own the stock through market close right before the ex-dividend date. So basically what the purpose of an ex-dividend date means is you're exempt from the dividend. The new buyers on the ex-dividend date do not get dividend for the recent dividend payout, even though they're before their record date. The record date is not as important as the ex-dividend date and the must-own date. The record date basically is just a couple days after the must-own date is the money clears, and that's the date where they officially have record of who had stock at that point in time and who gets the dividend. So the record date kind of throws people off because technically you need to own it. You need to own the stock at least 2 to 3 business days before the record date. So don't really look at the record date too much. You really need to own it the day before the ex-dividend date. You can actually sell it on the ex-dividend date and be eligible to earn those dividends. So literally you can buy at 3:59 p.m. and buy a stock right on the must-own date. And you literally can sell it that very next day on the ex-dividend date at 9:31 a.m. when the market opens and get the dividend. So you literally can own the stock for 2 minutes, technically. I do not recommend that. And I'm sure most people will tell you that's not the way to go. But technically you can. So that's dividends in a quick nutshell.
So when you want to find a dividend stock, you can simply look for dividend calendars. So NASDAQ's pretty good. You always want to follow through and just double check with the dates here and actually check on the stock sites just to double check. So I like NASDAQ dividend calendar to find dividend stocks. So it has the symbol, the name, it has the ex-dividend date. Don't forget you have to purchase it the day before this date. And it also has the announcement date, so you can just double check to make sure this is more up to date and recent with everything that's going on with COVID. And remember, the record date, it doesn't really matter too much. What really matters is that you buy the stock and hold it through the trading day before the ex-dividend date. It also has the annual dividend and then what you're going to get on this particular dividend. So this is 19 cents for this particular dividend, 8 cents for this one. So you can kind of look into all the different stocks and kind of figure out what they're paying out. And you can kind of go through upcoming months to make a plan for potential stocks that you'd want to look into for dividends. All right, an example of how dividend impacts the stock price on the ex-dividend date. This is ARE stock, and the stock could go up or down heading into the dividend depending on other factors. But this stock dividend date was December 30th. So if we go back to December 30th on the calendar, we can kind of see that ARE was $1.09 for this particular dividend. So this is a company pays out pretty good dividends, $4.36 annually and $1.09. So this is paid out quarterly. So this closed on December 29th, the day before. This is the must-own date right here. So it closed at $175.26. It opened lower, right? It's going to open $1.09 lower. With the pre-market, it may go up or down. So that's why it opened up at $173.93. But you can see that the stock opens lower because of the dividend that was given out. So this stock closed here and it would have opened $1.09 lower. And then it goes up or down based on market supply and demand.
Now, again, you have to be careful with dividends. You want to make sure that you crunch numbers and you look at how often companies pay out their dividends, because a lot of people get big eyes when they look at the annual dividend total, but they don't realize that it's actually paid out monthly. So you have to factor that in as well. First, you want to figure good companies that you want to invest in, aside from dividends, companies that you really feel strongly with in terms of fundamentals or growth. Then you want to look at which companies have a high dividend yield percentage. After that, you want to figure out how often they pay out. So is that monthly, quarterly, etc.? And then you want to do some math, figure out how much the actual stock price is, what you can afford, and whether you think it's worth it or not. Again, blue chip companies that are stable and aren't really going anywhere, those companies are safe bets. However, right now with economic downturns, coronavirus, etc., world events, these companies can temporarily suspend or take away dividends. We've seen General Electric lower their dividends. A lot of companies have actually, Disney just announced they're going to suspend their dividend temporarily. So you want to look back into that. You want to find recent news on dividends. You don't want to go by older websites. You want to go to the actual company's websites just to double check and get it right from the source, okay? You never can be too careful with a lot of these sites. A lot of them are outdated. So keep in mind, with dividends, there are other factors that make the stock price go up or down. Sometimes if you invest in dividends right before the ex-dividend date, stocks can drop and kind of go down for a little bit. Other times you can see stocks kind of rise up towards the ex-dividend date, and then a lot of people sell right during that ex-dividend date. So stock prices can be kind of funky with the dividends. So what I recommend doing is going back and looking at the company's history, how it performs after the dividends. So if you're going to invest right before a dividend date, then make sure that this company usually is stable after the dividend is released. And of course, nobody can predict a lot of these events or different news things that are released. So everything is do your own research and kind of figure out what your philosophies are on dividends. But I hope that you found this video informative and help kind of understand what dividends are. So hope you guys enjoyed the video. Make sure you hit subscribe. Thanks again for watching. We'll see you guys next time.